Jonathan Camarda, Chief Investment Officer. Hopefully you're all doing well. It's been a few weeks, so let's dive right into the action. Well, inflation has been the operative word of the week, the month, the quarter, and for that matter, the year. So again, some government officials have come out recently and admitted transitory is probably not the right word to describe it last year. Many fund managers, economists, and analysts alike already saw that months ago into last year. So where does that leave us now? Well, we did have a reprieve from the inflationary winds last month, so you might have seen an infusion into short-term treasuries, which were so oversold and had juicier yields to offset some of those cash positions. Now, with the recent jobs numbers and the heating up of inflation, that machine cranking back up again, we've shaved some of that treasury exposure in favor of the U.S. dollar, which has done very well with rising rates, as kind of a counterbalance there. Now, we've stayed steadfast, of course, and increased exposure, and it's worked out well for you as in energy, materials, and commodities, as we've had a pretty strong commodity cycle, energy prices moving with more strength than they have since 2014, and continue to do so. If you look at supply demand, you look at the macro picture, again, gas, food prices continue to rise. So therefore, we take advantage of those areas in increasing exposure and staying disciplined until proven otherwise. Now, you might have seen some other asset classes added in to hedge some alternative assets, such as, again, senior bank loans, which are not as rate sensitive as bonds and treasuries, provide a nice yield, and again, are a pretty attractive asset class in this environment. Now, the other things we looked at are oversold areas that we've increased exposure are semiconductors, and drum roll please, believe it or not, yes, China, which is so moves off of a firm floor. Now, we don't forget, however, so don't kid yourself, that we are firmly in an Alaskan Kodiak grizzly maze, however, with the S&P, NASDAQ, and Dow Jones below their 50 and 200-day moving averages. Now, the glimmer of hope that we've seen institutionally is that the S&P on an interim basis, keyword interim, back in May 20th, bottomed at 3810, and we've seen flows since then and some strength. Now, with that being said, the Russell 2000 today, June 7th as a reference, actually the price popped above the 50-day moving average. Now, the Russell 2000 small caps, for that matter, are usually the canary in the coal mine on the way down. In other words, again, they started to show weakness before any of the other indices last year, and certainly on the way up, they do the same. So most technicians and analysts look at this simply as a mid-year bounce. However, as you know, markets don't move straight up and down, right? They move in jagged, wave-like cycles. So you have to take advantage of every ounce and inch that you can. So when the bear market's over, again, you optimize what we call in the business our upside-downside ratio. What that means in English is we want to participate as much, if not over on the upside, and as little to the downside. So it's a constant tug of war, but we stay eternally vigilant to do so for you. Now, that being said, if the idiosyncrasies of your situation or the uniqueness of your risk appetite, if you have questions, certainly address them to your PWA on how the strategies address those and overlaying them. Now, again, we never forget that you're the boss, we work for you, and it is truly a privilege to serve you and your families. Until next time, appreciate your time, your patience, and most importantly, your trust. Jonathan Camarda, signing off.